I'm starting with a daily chart of the NASDAQ composite. Now, as most of you know, 90% of what I use to judge the health of the market is the price action of growth stocks. It's all covered in the seminar videos. I'm looking for strong fundamental companies, meaning companies with strong earnings and sales growth, and combining that with breaking out of strong technical patterns, again, covered in the technical patterns video. And I'm looking for breakouts. I'm looking for these stocks to break out on strong volume, hold their breakouts, and the broader the sectors, the more stocks that are participating, the better. Why is this important? Because in healthy markets, that's exactly what happens. We start to see stocks breaking out, institutions consistently putting money to work, and a nice sustained uptrend. Now, how does this apply to the current market, or why is it important now? Because I'm just not seeing that type of price action. I've talked about in the past few weeks of videos when I review the positives and the negatives, I've talked about one of the negatives being still not that consistent price action that I'd like to see in growth stocks. I've said that the indexes are acting better than growth stocks, but we're still not seeing those breakouts and a lot of setups. Now, in last weekend's video, I mentioned that things were slightly improving, but I still wanted to see these stocks prove themselves. And unfortunately, we're back this week to that uninspiring price action where it's sort of described as washing machine price action, where sometimes they're trying to break out and failing, or they're setting up and having quick shakeouts and then reversing higher, but overall uninspiring price action that's making little progress. And we're not seeing that type of consistency that I'd like to see in a healthier market. Now, one of the members emailed me and said, why is this price action happening? And the main reason is the Fed. There's a reason Marty Zweig came up with that expression, don't fight the Fed. It's liquidity. When they're taking liquidity out of the system, you're going to have these types of corrective churning bear markets. Now, I don't want to get too much into the macro, but we started the year at 0% Fed funds rate. We're at about 4% now, and the target or terminal rate is 5%. So we're most likely going to see a 50 basis point hike at their meeting a week from today, then another 25 and 25 in 2023 to get to 5%. But just because they get to that terminal rate, it doesn't mean go all in and to get aggressively involved in the markets, because they've talked about the term restrictive, that they want to maintain that rate at that level to restrict buying, restrict demand, because let's not forget their main objective is to fight inflation, and they want to kill demand by keeping interest rates high, mortgage rates high, variable rates, credit card rates, and so forth. So again, their main goal is to attack inflation. The other thing is that their balance sheet is another way they can take liquidity out of the system. So they might maintain that Fed funds rate at a certain level, but they can job on the market by saying they're going to reduce their balance sheet or let some of the assets run off. The whole point is that, to keep it simple, that continues to take liquidity out of the markets. So what's the conclusion from all this? It goes back to what I've been talking about, defense, defense, defense. A few members have actually emailed me and said that the consistent message I've been giving this year is defense. If you're going to trade anything, keep things light. And specifically by defense, if you're going to trade anything, number one, try to trade the stocks that have higher relative strength, that are surviving this bear market so far, at least to give yourself a chance with higher probabilities. It doesn't mean they're going to work, but I'd rather you trade stocks in uptrends than the ones that are 70 to 90% off of their highs in severe downtrends. Number two, I've talked so many times about getting those strong entry points. Do not chase extended stocks, because bear markets will punish you when you chase extended stocks. Number three, keep things light. Lighter than normal positions can help you deal with the higher than normal volatility. And number four, you still got to stick to a loss-cutting discipline. Just because you trade higher relative strength or higher probability names, they can still turn against you, and I've given you the guidelines for where to stop yourself out. The other point I want to make is that from the questions I'm getting on emails, from some of the comments on the webinars I've been running, there are a lot of members that are 100% invested, and some members have told me that they're on margin. I never tell anybody what to do, but I want to stress the concept of just round numbers. If you have a $100,000 account, you don't need to be fully invested. You can have 20,000 of it in cash, 50,000 of it in cash, maybe more. You might say, well, I need my cash working for me. If you are retired and you need that dividend income, I totally respect that. And I understand that. As I always say, do what works for you and your own investment objectives. However, this isn't like we're missing out or opportunity cost by staying in cash for 3 years. It's just temporarily until market conditions improve. So I want to stress the point that cash is a position. A couple other points I want to stress before I get into the stocks is that, breakouts don't work. I want to remind you, they don't work in corrective and bear markets. And these pullback buys, all these techniques are not going to be as effective and as consistent when we're in a bear or corrective market. When we get out of this, there'll be a lot of great opportunities. And I'm not saying that the market has to go lower. I'm not saying we have to crash or anything like that. I just think that it's best to keep things light and to be patient, because I'm just, again, not seeing that consistent price action, that consistent trend. So we could still be in a range. We could still oscillate around, but by keeping things light, that can help prevent damage to your portfolio. Because as I've said so many times, I have a million objectives with this product, but one of them is to keep you on the right side of the markets. And for the most part, I've been preaching defense this year. And if you're going to trade anything, make sure to keep your positions light.